You're staring at a $500,000 house in 2026 and thinking, okay, so I just need a higher income, lower rates, a smaller ego, and a rich uncle. Totally reasonable. But here's the real question. Who can actually afford a $500,000 home without turning their life into a monthly anxiety membership? Because the bank said yes is not the same as my life will still function. A lender mostly cares whether you can keep paying if nothing dramatic happens. You, on the other hand, have to survive reality. Groceries, car repairs, childcare, layoffs, and that one surprise roof leak that shows up like a villain in the third act. So let's do the thing real estate hype hates: math with consequences. We'll use clean, boring assumptions and see where the numbers land, and then we'll talk about the kinds of people this price tag is actually built for. First, the purchase: $500,000. The down payment: let's be generous but realistic and say 10%. That's $50,000 up front. Already pause. That's not skip a few lattes money. That's save aggressively for years or get help or sell something money. And it's not the only cash you need. You'll also pay closing costs, loan fees, title, escrow. All the fun stuff that feels like buying the house comes with buying a second, smaller house made entirely of paperwork. Call it a few percent of the purchase price depending on your loan, location, and points. So your cash to close might be closer to $60,000 to $75,000, even before you buy your first curtain. Now the loan. With 10% down, you borrow $450,000. Assume a 30-year fixed rate around 6%, not because the exact number is destiny, but because it's a realistic neighborhood for recent years. At 6%, the principal and interest payment on $450,000 is roughly $2,700 a month. That's the part everyone screenshots and posts like it's the whole story. It's not. Principal and interest is the cover of the book. The plot twist is everything else. Next, property taxes. This is wildly location dependent. Some places tax you like they're funding a space program. Other places are calmer. But even a modest tax bill can easily be several thousand a year. On a $500,000 home, a reasonable ballpark in many areas might be $400 to $900 a month. Then homeowners insurance, again, varies, and in some areas it's rising like it's trying to outrun the weather. But let's say $150 to $300 a month. Now maintenance. This is the cost nobody budgets for because it doesn't come with a nice checkout page. A common rule of thumb is around 1% of the home value per year, give or take. On $500,000, that's about $5,000 a year, or roughly $400 plus a month. And that's before you get hit with the "it's not broken, it's just old" tax. Replacing appliances, painting, pest control, landscaping. The small stuff that slowly drains your wallet like a leaky faucet. And if you put less than 20% down, you may have PMI, mortgage insurance, basically a monthly fee for the privilege of not having a massive down payment. Depending on your credit and terms, that can be anywhere from annoying to, why am I paying rent to my own loan? Let's keep it conservative and say $100 to $300 a month. Add it up, and you're staring at a monthly housing cost somewhere around $3,400 on the low end and $4,500 plus on the realistic end in a lot of markets. And we haven't even talked about HOA fees, which can appear out of nowhere like a jump scare. So let's pick a middle scenario to run the income math. Say your total monthly housing cost is $4,000. What does that require? Here's the affordability rule most people try to ignore until it's too late. Housing shouldn't eat your entire paycheck. A classic guideline is to keep housing around 28% to 30% of your gross monthly income. Not because it's morally correct, but because it leaves room for savings, emergencies, and living like a human. So if $4,000 is 30% of your gross monthly income, your household gross needs to be about $13,333 a month, or about $160,000 a year. If you aim for 28%, it's closer to $171,000 a year. Now, can a bank approve you with less? Sometimes, yes. Lenders often look at debt-to-income ratios, and some programs allow higher percentages. Translation: you can be approved while still being broke, just on paper. Approval is a risk calculation for them. Affordability is a quality of life calculation for you. And this is where people get trapped. They treat the maximum the bank will tolerate as the minimum they should accept. That's like using the red line on your car's tachometer as your cruising speed. Sure, the engine can do it, for a while. Now let's make this painfully practical. Say your household makes $120,000 a year. That's $10,000 a month gross. A $4,000 housing payment would be 40% of gross. And that's before you add other debt. student loans, car payments, credit cards. 40% might be survivable for some situations, but it's usually tight, especially if you also want to invest, travel, have kids, or experience joy. If your household makes $100,000, you're at $4,000 being 48% of gross. That's not a budget. That's a hostage situation. And yes, people do it. They do it by cutting everything else, by leaning on future raises, by temporarily pausing retirement contributions, and by praying nothing goes wrong. The point isn't to shame anyone. The point is to expose what the price tag actually implies. So, who can actually afford a $500,000 house in 2026? Let's be honest, typically one of a few groups. Group 1, dual income households with solid earnings. Think 2 professionals or 1 high earner plus a decent second income with stable careers and benefits. If 2 people earn $90,000 each, suddenly $160,000 plus is on the table. Not easy, but plausible. Group 2, people with meaningful equity from a previous home. If you bought years ago, road price increases, and sell your old place, you might walk into the new one with a bigger down payment, sometimes enough to avoid PMI, or even get closer to 20% down. That changes the monthly payment a lot. This is why just buy a starter home can sound like comedy in 2026. The starter home is often already $500,000, and the people buying it are using yesterday's equity as a cheat code. Group 3, people with family support, gifts, inheritances, living at home to save, co-signers. It's not always glamorous, but it's common. The modern down payment is often a team project. Group 4, strategic buyers who don't buy a normal house in a normal way. They house hack, buy a duplex, rent a room, add an accessory dwelling unit, or live with roommates longer than their pride would prefer. They're not just buying a home, they're buying a mini business that helps pay the mortgage. And Group 5, the group no one wants to admit exists but absolutely does, is people who are stretching. They can technically make the payment, but they have no margin. One job loss, one medical bill, one major repair, and the whole thing turns into a slow-motion panic. They're not purchasing stability. They're purchasing a fragile monthly obligation and hoping life doesn't notice. And now, the mid-video gut check, because this is where the real value is. If your housing costs became $4,000 a month tomorrow, what breaks first? Is it your savings rate, your retirement contributions, your ability to handle an emergency without debt, or your relationships? Because money stress is basically emotional acid. Be honest in the comments. What's the maximum monthly payment you could handle and still save at least 10% of income and keep an emergency fund growing? $2,500. That number is your real affordability, not the approval letter.
Now, let's zoom out for a second, because competitor scripts love to make this sound like a purely personal problem. Like, you just need better budgeting and less avocado. But part of what's happening is structural. Prices rose faster than incomes for a long time. Rates jumped, and costs around ownership, insurance, taxes, maintenance didn't politely stay in the background. Also, housing isn't just housing anymore. It's an asset class. It's a retirement plan. It's an investor playground. So in many markets, $500,000 isn't priced for the median household. It's priced for above median earners, for equity rollovers, and for people with outside help. That's why the math feels brutal. It is. But brutal math can be freeing, because it stops you from internalizing the situation as, I'm failing. You're not failing. You're running the wrong equation. So what do you do with this? You have 3 levers: price, payment, and risk. Lever 1, price. The simplest affordability hack is still buy less house. Smaller, older, farther out, different neighborhood, different city, different state. I know, revolutionary. But the math doesn't care about your Pinterest board. Lever 2, payment. Bigger down payment, better credit, shopping lenders, buying points carefully, choosing the right loan type, and, if it fits your life, renting out part of the property. Even an extra $500 to $1,000 a month from a room or unit changes the whole equation. Lever 3, risk. This is the underrated one. You don't just ask, can I pay this now? You ask, could I pay this if one income disappeared for 6 months? Could I pay this if rates stayed high and I couldn't refinance? Could I pay this if my car died and the water heater died in the same month because the universe enjoys jokes? If the answer is no, you're buying a home with a hidden clause. You must have a calm life forever. Good luck with that. And let's address the rent debate before it starts a comment war. People say renting is throwing money away. Sometimes, but so is overpaying for ownership, just with extra responsibilities and a lawn. If buying forces you to stop investing, eliminates your emergency fund, and makes you live on the financial edge, you didn't buy an asset, you bought stress. The goal isn't to own a $500,000 house. The goal is to build a life with margin. Margin lets you invest consistently, handle problems, and make decisions without panic. That's what actually builds wealth, not a fancy address, but a boring, repeatable surplus. So here's the bottom line. In 2026, a $500,000 house is typically comfortable for households around $160,000 to $180,000 in many scenarios, unless you have a large down payment, unusually low taxes/insurance, or additional income from the property. Below that, you might still make it work, but you'll usually be trading something: savings, flexibility, peace, or time. And if you're still thinking, okay, but what's my number? That's exactly where we go next. In the next videos, I'll show you how to calculate your personal maximum home price using a simple stress test, not vibes, and how to compare buying versus renting, plus investing the difference. Because sometimes the smartest move is not the one that looks successful on Instagram. It's the one that keeps you solvent. Click one of those next, and let's keep the math honest before the mortgage becomes your personality.